Sometimes you want to own gold. Sometimes you don't, right? There's a time and a place for everything. And if you're not understanding and recognizing what type of market environment we're in, is it trending? Are stocks going up? Are stocks going down? Is it a sideways, messy market? How are interest rates affecting, right? Because that's what really moves the markets is the bond market. $120 trillion asset class is what's driving those asset prices. It starts with the bond market. So understanding where we are in the cycle, understanding the drivers of the market is how we decide which tools and strategies to implement in that market.
Hello, I'm Addison Wiggin, and these are the Wiggin Sessions. Today, I'm joined by Parets, the founder of All-Star Charts. He's one of the most widely followed technical analysts in the world. All-Star Charts is a research platform for both professional and retail investors. They cover U.S. and international stocks, interest rates, commodities, forex markets, you name it. JC is a chartered market technician, designated CMT, and a frequent speaker at top investing conferences and universities around the world. He has the distinction of being the first market technician to come onto the Wiggin Sessions. In today's session, we had a lot to talk about, and frankly, he's an entertaining guy. It was a lot of fun. JC explains why he uses technical analysis because it's the only way to get paid in the market. That's what he says. He then walks us through the markets. The Dow, he says, is the OG. The SP500 is the benchmark. And the Nasdaq, well, it gets all the girls. Like a basketball team, each market has a role to play in determining market momentum. JC explains how you can identify a classic short squeeze and make money as traders who are trying to sell stock short are forced to sell and cover their shorts at higher and higher prices. Buy high and sell higher, he says emphatically. Then we take a brief detour into the behavioral psychology of traders, including how the recency bias clouds your judgment, what the cognitive revolution of 70,000 years ago has to do with the stock market, and the narratives we tell ourselves as we listen to the mainstream news. And also why euphoria in a rising stock market can also lead to really bad decisions. Are you ready? Let's jam. How's it going, JC? We were just trying to figure out if we had met before here in Baltimore.
Probably have, small circles.
Yeah.
I appreciate the intro, appreciate the invite. Let's wrap. What do you want to talk about?
Yeah, I want to actually dig into technical analysts. You're actually among over 120 of these Wiggin sessions I've done. You're the first technical analyst I've talked to.
Wow. All right. Well,
as you know, we take a macro approach to economics, markets, politics, those kinds of things.
Sure.
But you've been writing some interesting stuff lately that I wanted to talk to you about. You've been particularly hard on perma bears, which I've found entertaining because I like your writing style and I like the way that you're pretty candid about your opinions. But before, I gave an introduction to you, but nobody knows you better than you. So why don't you give me some of your background and talk about how you got into, or even how you ended up founding All-Star Charts.
Yeah, sure. You talk about how you start with the macro. So do I, for that matter, right? But I am interested in the macro, what's actually happening in the macro and the micro too, right? I focus all my attention on what is actually happening in the market. So not the way that we think the world should be, not the way we want the world to be. As investors, we have to invest in the way the world actually is, right? So that's what I focus all my attention on. So the economy is lagging, right? It lags asset prices. It's not a secret. We know that. Like, we have the data, like, it's very obvious. It's not anything new. This cycle is not any different than any of those others. So, like, if you are an investor and you are putting economics first, you are making a bet that for the first time ever, the economy is going to lead the market. Or you could do what I do and bet that that is going to continue to not be the case. And asset prices, as usual, are going to lead. And then ultimately the economy is going to follow in the same way that the bear market started in February of 2021. The economy later fell over, but the stock market was already telling you. And just like the stock market bottomed in June of last year, right? Now you're starting to see some economic stuff that looks better, but the market was already starting to price that in last summer. So that's what I focus on. So in 2010, 2009, like after the great financial crisis, a lot of my friends were starting blogs. Like there weren't that many blogs back then, but some of my friends were, like Howard Lindzon, Josh Brown, Reform Broker, Phil Pearlman, not that I was friends with Zero Hedge, but Zero Hedge had a blog back then. We were friends with like some Business Insider folks who, had a more blogging style to their journalism and things like that. And those are just the circles that I was running in. And they're like, JC, why don't you have a blog? I was like, I don't know how to do that. Like, I don't really know. I read blogs, I can log into my Twitter account, but like it ends there. So then one of my buddies, Phil, was like, all right, JC, we're going to build a blog for you. Because I already had a kind of like an email distribution list, friends and family that I would like update, particularly during the financial crisis, because I had a front row seat to what was happening. We were short stocks, the whole thing. But I wanted the rest of my family and friends to know what the hell was going on. Some would ask me, some I just felt obligated to explain that the world's falling apart and why we need to be short stocks and the whole thing. But anyway, so since then, that was sort of that's what sparked the beginning. That was the genesis of financial, social, FinTwit, financial blogosphere, like this whole world that you see today, this global communication network in over 100 countries around the world, talking about investing, talking about the economy, venture capital, crypto, stock trading, just every day, this conversation. This started out as happy hours in Soho, right? That was the beginning. And the financial collapse was finally all right, we can't trust the media. They got it all wrong. They were prancing these sell-side analysts around all bullish right before the crash. They know nothing. You can't trust them anymore. And like, not that you could trust them before that, but that was finally like, oh, okay, yeah, they're definitely not here to help us. And then you can't trust the banks. This is all their fault anyway. Like, you can't trust the banks. So who can you trust? And there were a few blogs already, and you could start going to the source. If you're interested in the Fed, you don't turn on the TV. You go to the Fed expert who's got this blog. If you're interested in, M&A rumors, you go to the M&A rumor blog. If you're interested in technical analysis, you go to the technical analysis blog. If you're a financial advisor, you go to the financial advisor guy. If you're into behavioral finance and behavioral economics, you go to the you can go straight to the source for the first time in history, as opposed to having this third-party intermediary of some analysts with their own biases and conflicts of interest giving you information. Like, by the time you get it, like, trust me, that you're not getting facts there. And same thing with the media, right? The media has they have other goals. Like, their goal is not to help you make money. That isn't a goal. That it's not only not their number one goal, that isn't a goal at all. The media's job is to get you to consume their content, period, right? So once you understand the way the world actually works, when you finally understand the motivations behind people, it really makes life a lot easier, because then you could just focus on what actually matters. And as an investor, right? So I don't write gossip columns for a living, right? If I did, then I could worry about the Fed and this. That's not what I do. My job is to make money, right? Period. So if that's my job, then we can't worry about all the narratives and the Fed and we have to focus on what's actually happening. And that is the direction of the price of assets. Unfortunately, asset prices are not random, right? It's not, people are like, oh, it's random. Yeah, it might look random to you, right? If I look at, some science from some biotechnology company with a cure for cancer, and I look at their data, it's going to look like Mandarin to me because I don't understand that, right? But when you understand how to study asset prices and you just do the math, asset prices are not random. Market prices trend. We know that. And that's why technical analysis works, because what are we doing? We're looking for trends, right? Yeah, anyway, that's the story. That's what I got.
Yeah, you're active on Twitter too, and I just wanted to read a Twitter that you wrote, which pertains to what you're just talking about right now. You wrote recently, the Dow is the OG, the SP is the benchmark, and Nasdaq gets all the girls. But the value line geometric index might be the one that actually gives us the best information. Yeah. So explain that. First of all, you'll have to explain to my readers anyway what the value line geometric index is. But also, I've had that same feeling about the Dow being OG for a long time, but it's still one of the major, indexes that gets reported on the news. And when the Dow moves, generally S&P and Nasdaq move in lockstep. So maybe you could just dive into that tweet a little bit and explain what you mean.
Listen, rule number one, don't fight Papa Dow. That's how I learned it. Don't fight Papa Dow. You want to know where the market's going? Follow the Dow Jones Industrial Average. You want to know where the Dow Jones Industrial Average is going? Look at the 30 stocks that are in the Dow Jones Industrial Average. It's not going to take you that long, right? If more of them are going up, the Dow's not going to go down, right? If all the Dow components are going down, the Dow's probably not going up, right? It's a very simple weight of the evidence. The Dow is the OG. Shout out to Ralph Acampora, one of my mentors. You know, I could just see him. JC, don't fight Papa Dow. Like I could just see that. Rule number one, don't fight Papa Dow. The SP500 is the benchmark. A lot of institutions are benchmarked to the S&P. You know, a lot of mutual funds are benchmarked to the S&P. Are there some other benchmarks? Of course. But the S&P 500 is the benchmark. So if you're going to grade yourself, if you're a professional institutional PM, you're going to be graded. You're going to be judged against the S&P 500, whether you like it or not, right? Because I've been on the other side and I've tried to convince investors, well, don't judge us versus the S&P. Guess what? They're judging me against the S&P 500, right? So that's the benchmark. But the Nasdaq gets all the girls, right? Chicks dig the long ball, right? Is the old saying. That's the Nasdaq, right? That's going to have the growth, the tech, the sexy stories about, you know, this consumer service or product, or, you know, some new technology. Like all that stuff is stuff you're going to find in the Nasdaq. You know, some of the, you know, if you're a journalist and you want to get people to read stuff, you write stories about those kind of companies, right? Like that's just what it is. But as an investor, it's important for us to understand that there are other kinds of stocks that are not in the Nasdaq, right? Like, for example, the Nasdaq is definitely not the stock market. The Nasdaq has 0.0% exposure to energy, right? So as energy prices have done so well, how has that helped the Nasdaq? It has not. The Nasdaq has 0.0% financials, 0.0% real estate, 0.0% materials, 0.0% industrials. That's a lot of stocks that carry no weight whatsoever in the Nasdaq. So it's not that the Nasdaq isn't useful. It's not that the Nasdaq doesn't count. It's that the Nasdaq is the Nasdaq. It serves a purpose. There are specific types of stocks that are in the Nasdaq, and sometimes they're in favor and sometimes they're not. But there's good information there. So don't misconstrue my, clarity here. We look at the Nasdaq every day, and the S&P, and obviously the Dow. They all have their role, right? You need, on a basketball team, you need a center, you need your guards, you got some forwards, right? You got the big thug that just comes in and plays D against their center. Whatever, there are different role players, and the value line geometric index is one of those role players. Except the value line geometric index is not mega cap tech stocks. It's not small cap biotech stocks. It's not an energy index. It is the median stock, right? You're looking at the median stock, not the average stock. You're looking at the median stock in the market. There's about, I think last I checked, like 1,600, 1,700 names in the value line. The data goes back 40 years, 40 something years. So you got good data, and it's not the average stock, it's the median, but it's basically like your average Joe, right? It's not the biggest, it's not the smallest, right? It's not the most growthy, it's not the most value, it's right smack dab in the middle. So it really gives you some good perspective on what's happening underneath the surface that might be hidden from some of these mega cap indexes that are just mega cap stocks, not the others.
Yeah, you in a recent email that you sent out, you make the distinction between the market, and you put market in quotes, and I think your comment was there is no market. It's a market of stocks, and each stock has its own behavior. And then your approach of using technical analysis helps to figure out what trends are in place for individual stocks, and then as an aggregate, you can see what the market of stocks is doing. Right. Generally, we talk, we criticize the Fed, and we talk about history on here. We talk about, the war in Ukraine and supply chains and all that kind of stuff. Those are big macroeconomic themes. and you made the distinction between macro and the economy and what the stock market is actually doing. I wonder if you could drill into that just a little bit, just to really make the distinction between the macro narrative that we talk about all the time and how you use, or how do you drill down into technical analysis. You can kind of unlock some of the phrases that we keep hearing from technical analysis, like head and shoulders and 5 up, 5 down, and stuff like that. I'm just curious what the connection between whatever macro narrative you see and how you drill down into the charts.
Yeah. So just to be clear, I don't count waves. I have a head and 2 shoulders. It doesn't mean my charts do. So all that silly stuff, you know. Remember what technical analysis is. Which I think is really good, what gets lost from people who just either ignore it, or, you know, most people are technicians, they just don't realize it. Technical analysis is the study of the behavior of the market and therefore market participants, as opposed to the goods and the services in which a particular market deals with, whether it sells shoes or computers or chips, or lies about what gold is in the hole that they're digging, right? At the end of the day, price is the final arbiter, right? A lot of people have fundamental views. This company's great. This company's terrible. The war is going to impact stocks this way. The Fed is going to impact stocks that way. You know, what the inflation, this, the disinflation, the stagflation, you know, everybody's got inflation. Fine. None of those people's opinions pay anyone. It's only the market's opinion on the fundamentals that pays anybody, right? Not Joe Schmo, Morgan Stanley strategist, or, you know, Pepe over at UBS, or their opinions are fine. They're probably really smart people. I have no idea. It's only the market's interpretation of those fundamentals, of those earnings or lack thereof, et cetera, that matters. So if we know that, then we do know that, right? So we ignore everybody else's opinion and focus solely on the only opinion that actually matters, which is the market's opinion. So price moves first, and then comes the narrative. Stocks rally due to inflation. Stocks fall despite inflation, right? Like, the journalist already knows what the reason for the move is going to be. It's just whether the market went up or down, right? You know, why is oil up? Oh, look, explosion in Syria. Oil up because of explosion in Syria. It's nonsense. Tesla doubled in the month of January. Nothing fundamentally changed in Tesla from December to February. Nothing. You know what changed? All these shorts had to cover.
Yeah.
Right? They got squeezed the hell out. And in Carvana, Bed Bath & Beyond doubled the other day overnight. Like, you think Bed Bath & Beyond now all of a sudden is a great company? No, someone got squeezed, right?
Yeah. Yeah, actually, that was something I wanted to bring up, because at the opening, I had mentioned that I've been enjoying your commentary on perma bears getting squeezed. And the best way, we use that term squeeze all the time. But it's important to actually explain what it is. Mm-hmm. Like, what is a short squeeze, and how do you use charts to identify one? If you're not using like all the mumbo jumbo technical analyst terms like to throw around, what is it that you're looking for? You're looking for a trend to be in place for 20% or something like that.
So remember, technical analysis doesn't necessarily need charts, right? Technical analysts use a lot of charts because it just so happens that the best way to visualize the changes in equilibrium between supply and demand just happens to be in chart form. So there's a lot of charts involved. But when it comes to short squeezes, it has nothing to do with the charts. You just calculate how much short exposure is present relative to the amount of shares outstanding, right? In some cases, you have 30% of the float is short. Some cases you have 50, 60, 70, even 80% of the entire float is short. And what people fail to remember, it's just math. Short sellers are promising to be a buyer in the future. They have no choice. You're a short seller. You have to buy at some point in the future. Short sellers would love it to be at lower prices, but whether it is or whether it isn't, they are guaranteed future buyers. Shareholders of companies are guaranteed future sellers, right? So just understand that concept. To unwind a position, you have to do the opposite. So when you're selling short, you have to buy. You have to carry a margin requirement in order to be short a stock. The way that you short a stock is you borrow it, promising to give it back, and you pay a margin interest on that borrow. You sell it in the open market, you take the cash, and then in a perfect world, you buy it at a lower price for less money and you keep the difference. You return the shares. That's how short selling in a perfect world works in a profitable short selling strategy.
In a perfect world.
Yeah, in a short squeeze, it is the exact opposite of that, where the short seller was hoping to buy it back at a lower price, but actually ends up having to buy it back at a higher price. But what happens is, as the price goes up, in other words, the price is going against the short seller versus in favor of the short seller. And as that price goes up, the margin requirement gets higher and higher, to the point where the margin requirement is too high, because if you're short, you have an unlimited amount of risk to the upside. So you're going to get a call from your margin clerk, and your margin clerk is say, you need to cover by 1 o'clock today, or we're going to cover for you, right? And what happens is these margin clerks, they're not going to enter limit orders, right? They just need you out. They'll spray the market. I don't care what price you get. Just get it out of here, right? So what happens is they get squeezed out, whether they like it or not, right? Forced buyers, if you will. They're forced into it by the margin clerks. And then as the price moves further, that triggers other short sellers that are forced to cover, which triggers more short sellers that are forced to cover. And at some point along the way, we see it and we start buying it, helping the scenario. And a lot of other people too, like, we're not the only ones with the magic data. Like, it's right there. It's all free information. And the momentum traders like us, we get involved, which causes even more shorts to squeeze, which brings in more momentum traders, which causes more margin calls. And all of that happens all at the same time, which is why you get 400% moves in a week in the worst company in the world, because everybody knows that shrimp made out of soy is a dumb idea, right? Everybody agrees, clearly. That's why the short interest is so high, to the point where anybody who's already come to the conclusion that soy-based shrimp tastes terrible and meat made out of plants instead of a cow is a horrible idea, everybody already agrees. Everybody's already short, to the point where there's nobody left to sell. And there goes the unwind, and all those shorts get squeezed. Beyond Meat can still go to zero. Bed Bath & Beyond is probably not going to be the next Amazon, right? But guess what? It's doubled twice this year, and it's only February the 9th.
Yeah. Yeah. So what are you looking for when you're trying to identify a short squeeze? Because as a momentum trader, you're looking for the momentum, and you're reasonably confident that if you buy it at this price, you can sell it at that price.
So you're looking, number one, for the catalyst, and number two, for the entry. So the catalyst is days to cover, the short ratio, as they say. So that is the amount of shares that are short divided by the average daily volume. So in other words, how many days is it going to take for all of those shorts to cover? The higher the short ratio, the bigger the squeeze is going to be, right? So that's the catalyst. And then you're looking for an entry point, right? At what point is that unwind getting started? And that's what triggers the entry point. And that's where the momentum comes in.
So in that scenario, you're not looking at fundamentals at all. You use Bed Bath & Beyond. What do you make of meme stocks like AMC Entertainment?
Yeah.
And stocks, or GameStop, I think, was another big one.
Yep.
Even Tesla was considered a meme stock for some time.
No doubt.
What do you make of those? Those are momentum plays if they get, if the Robin Hood crew.
That was a few years ago. So these days there's new names, right? Like, those names are now something else, right? Like, it's called meme stocks because most people haven't moved on, right? But there are stocks today that are like those then, right? Like, people think meme stock once, meme stock forever, but that's just not the way it works. Those had very high short ratios, and you got the squeeze, and then it's kind of just been like, this other thing ever since. There are new names like Carvana, like Tesla, like what's the bank out of San Diego or La Jolla? SI. What's the name of the damn bank? Silvergate Bank out of La Jolla. Another one. I think it's like 80% short. There's this auto dealership, SAH. It's got like a 20 days to cover. That's a month of average daily volume just for the shorts to cover. Like a third of the float is short. Stock's making all-time highs, by the way. It's very, so there are opportunities. It's just that the AMC and the GameStop, and I think BlackBerry was part of that crew back then.
Yeah.
Had their moment. And then they become something else since then. And there are different names. Because what happens is these hedge fund managers, they have their idea dinners. They are together, these billionaires. They're eating their steak with their foie gras on top and, past the oysters and the champagne. And nothing wrong with that. I like doing all those things for the record also. But that's what goes on. And they're like, they all come with their best idea. I like buying this. I like shorting this. I like doing that. And then they all walk out of that idea dinner and they're like, oh shit, I'm shorting that Carvana. That thing's a real, So they all get in and they all short. So then they all get squeezed at the same time, right? That's how this works. And then what happens is there's groups of stocks that are being shorted at the same time. So while the domino effect of the same stock being shorted by a bunch of institutions all knocking each other out, those people that are short, those institutions that are short those types of stocks are short other stocks in that same category. So a short squeeze in Coinbase, for example, is going to create a short squeeze in Riot or Mara because the same institutions that are short the Coinbase are short those others also. So you're getting domino effects vertically and horizontally in an environment where short squeezes are thriving. And historically speaking, early on in bull markets, short squeezes thrive. This cycle, no different, obviously.
Do you ever find yourself going short?
Yeah, of course.
Yeah.
So
So
we shorted Google this morning.
did you? So explain the difference in your thinking when you actually choose to go short.
Well, I would never in my life, no matter what, I don't care how much you paid me. If you put a gun in my head, just shoot me, put me out of my misery. Then I would never short a stock with 80% short interest. Like you're begging to get wiped out, for example. So I would never short that stock. But a short like Google, the short interest is meaningless. Yeah, I can short that all day. I'm not worried about that, right? So, and by the way, most stocks, like almost every stock doesn't have crazy short interest, right? We're specifically looking for very unique circumstances where the amount of days to cover is egregious.
Yeah.
And we know that so there's a built-in catalyst that has nothing to do with earnings or the Fed or a war or not World War III, but yes, World War III or, has nothing to do with that. Stock prices do not move based on earnings. They move based on positioning or mispositioning, to be more specific.
I have a very rudimentary question. Where do you find the percentage of short interest in a stock?
Anywhere.
Where do you pick it up?
Go to Nasdaq.com, Yahoo Finance. I personally use Koifin. Anywhere. It's public data. In fact, They just changed the law. It hasn't been implemented yet, but until now, my whole career, the short interest gets updated every 2 weeks. And I think that now the law is either every day or a couple of times a week. It hasn't been implemented yet, but it's coming.
One of the things I'm still trying to just get a handle on the time horizon for a short and the number of days that it takes to cover. Yeah, one of the things he wrote recently was in my time frame, it's simple. I look for weeks and months. I'm not a day trader, but I also don't care what happens next year.
Yeah.
Not the long term and not too short term either. So I think it sounds to me like the days that it takes to cover a short are critical to your strategy for getting it.
For sure. And we have strategies that are longer term strategies, where we're looking out months and quarters. These short squeezes are not that. Yeah. We're talking about days, so I think there's a time and a place for everything. There are times in the market cycle where short squeezes are not thriving. That is not the type of stock that you want to be buying. But in the early stages of bull markets, those types of strategies tend to do very well. And this cycle is no different, right? We're 8 months into a new bull market. People are now starting to realize that stocks have been going up since last summer. Like where have you been? Because the thing is that a lot of people just focus on the S&P 500 and they think that that's the stock market, right? But if people would actually just take the time to go stock by stock and just count how many are going up and how many are going down. I mean, not to be over, not to oversimplify it, but I mean, all you have to do is count, right? And people just don't want to do that. They rather assume that one large cap index with an irresponsible amount of growth exposure in one country represents the stock market, and the market keeps proving that to be incredibly foolish.
Earlier this week, you wrote a piece in your email where you called February a bad hangover. And historically, the chart that you threw in there showed that historically, over a long period of time, February is not nearly as bad as September, but is one of the months that you can count on having a down month.
Yeah.
Is that something that you take into consideration when you're looking at one of these short squeezes or some kind of momentum stock that you're interested in?
Yeah, no doubt. Now, February is usually a bummer. The best time of the year, best 3-month period is November through January. Historically, that is by far and away the best 3-month period. Did it disappoint this year? No, stocks absolutely ripped during that period, right?
Yeah.
Absolutely ripped. They didn't just start ripping. They started going up in June, but they really got going in that sweet spot of a period. And by the way, it's not the first time we see it. This is perfectly normal. So there's not like any magic indicator. Stocks were supposed to do well and they did, right? So again, perfectly normal market behavior. But then what happens during times of exuberance, to quote, our boy Alan, during those sorts of times, you see what I did there? Dropping the little economist on there. See, I know.
Yeah,
I know.
That's Greenspan in case people aren't picking that up.
Yeah. Alan, he brought me plenty of headaches early in my career, but that's another story for another day. Ask yourself this: were people doing great? Were people having a good time? Were some people being a little irresponsible? Were some people acting as though they were under the influence, perhaps? I would say yes across the board, right? People were having a great time, myself included, right? What happens after that, right? There's kind of like, you pay the consequences, right? I mean, I don't want to speak for everybody, but I've definitely overdone it on a Saturday night and had to pay for it on a Sunday. Been there, right? Guilty. February is like that. You're sort of paying, for the market, sort of the investors in the market for that matter, sort of getting over their skis a little, and you sort of have a digestion. It doesn't mean the market needs to crash. It doesn't mean stocks need to collapse. Just a regular breather. And by the way, I don't know what the market's going to do next. I don't know if February is going to be a messy month. So far it has been, so makes sense. But historically, so where does that fall in my process? It's part of what type of market environment are we in, right? That's the first thing we want to do, because a lot of people, a lot of investors, the mistake that they make is that they have one strategy and they always push that one strategy on the market no matter what the market's doing. Why? Some cases it's recency bias, like, oh, I'm a growth investor. Why? Because growth stocks did so well over the last 10 years, right? Is that why you're a growth investor? Oh, I'm never buying gold. Why? Because gold sucked for a decade? So you're never buying gold now? There's recency bias. Then there's like I'm not like Mr. Bias expert, but like whatever bias, like success bias, where like this one time I bought this gold miner and it went up 50 times. So now for the rest of my life, I'm going to buy the shittiest gold miners I can find so that I can, reach that high again. Like, we know those people, or, early in their career, they make a lot. They start their career right before a massive collapse in the stock market. So they're a perma bear ever since. They're waiting for the next big one. We know those people. Then we know the perma bulls that started their career in the early 80s that are just buy and hold, baby. Just buy any pullback. We'll be fine. Right? Like you got to overcome those biases and understand there's a time and a place for everything. There's a time and a place for gold, not you should always own 3% of your portfolio in gold. That's the dumbest thing I've ever heard. Sometimes you want to own gold. Sometimes you don't, right? There's a time and a place for everything. And if you're not understanding and recognizing what type of market environment we're in, is it trending? Are stocks going up? Are stocks going down? Is it a sideways, messy market? How are interest rates affecting, right? Because that's what really moves the markets is the bond market. The $120 trillion asset class is what's driving those asset prices. It starts with the bond market. So understanding where we are in the cycle, understanding the drivers of the market is how we decide which tools and strategies to implement in that market. So if we're in a trending market environment, why on earth would you use mean reversion strategies? That's going to be no good in that environment. If stocks are going up, why are you forcing these short positions, right? You should be buying stocks. How should we be spending our time? Should we be spending more time looking for stocks to buy, or should we be spending more time looking for stocks to sell? Or are we in a trendless market environment where we want to be selling overbought conditions, buying oversold conditions? We want to be implementing mean reversion strategies, selling premium, selling volatility, collecting income. If you're in a trending market environment and you're selling out of the money calls, you're going to lose every time because that's just not a good strategy for that type of environment. In a sideways environment, you're much better off selling the wings. Sell the wings all day, right? The time and a place for everything.
Why do you think you mentioned that stocks started going up last in July, really, and then they continued all the way through the end of the year through January? Why do you think it takes people so long to see that the market has shifted? I mean, it seems like part of it is the macro narrative has been all about inflation and all about the Fed raising interest rates and trying to squash inflation as interest rates go up. The market has been going up too. So, but it seems like people have just been distracted and not really even noticing that the market has been going up. Yeah. You and I notice because we look at it every day, but
yeah.
So why do you think it takes people so long to notice the trend? And usually what happens, this is just from observation over time, that they figure it out right in the beginning of February when the hangover begins, and they get in at a high price, and whatever happens next is not good for them.
I think it comes down to self-awareness. Us humans, we've evolved over tens of thousands of years, right? Going back to the cognitive revolution 70,000 years ago, we've succeeded as a species in a lot of different ways. Our group thinking, sticking together, right? We have the ability to do that. Other animals do not, right? Like chimpanzees and stuff like that. They can't function in a group of more than like 8 chimps or something like that. Like they go crazy after that. Us humans, we can go to a football game with 70,000 people, and there are a few drunk ones that get in a fight, but for the most part, things are working just fine, right? One of the ways that we evolved and have succeeded as a species is our ability to tell each other stories, right? And pass stories on. So we have a need to be told stories. We have a need to tell stories, right? That's perfectly natural human behavior, right? We know that, right? We know that. So as investors, it is incredibly important to overcome those evolutionary biases and not allow that to influence our decision-making in the market. As human beings, we are not built to be great traders. Quite the opposite. When we are losing money, right? When there's money involved, our stress levels are elevated. In 2023, our stress levels are not elevated because we're being chased by a lion, right? Like it was 70,000 years ago, right? Where our stress levels were elevated because there's some sort of conflict with an animal or another tribe or whatever it is. In those cases, we want to run. We want to escape, right? In times of euphoria, right? We act irrationally as investors during times of euphoria where we think it's going to be great forever, but it is not. So it is important to sort of eliminate those biases. And it's a lot of different human biases, heuristics as they're called, that we need to be aware of that exist, that are perfectly normal emotions that you should have as a human. If you didn't have it, it would be inhumane. So it's important to recognize, hey, this is entertaining. This is entertaining to me, watching these two people who claim to be traders that have never traded on a desk with a lovely young lady arguing about a bull or a bear. Like that's entertaining to some people, right? I don't find that entertaining, but some people do. Great. I like watching college football, right? I like watching documentaries about like history or, new technology and stuff like that. That just entertains me. I'm not going to use, the fact that Tom Brady threw for 300 yards as a reason to buy Tesla, right? Like, what does one have to do with the other? Like, a discussion about the economy and a war. Maybe some people find that entertaining, but that should have no impact whatsoever on your decision-making in your portfolio. One has nothing to do with the other.
You recently noted that gold was starting to break out in currencies alternative to the US dollar, like euro, pound, even. What do you make of that? Is that like an early indication that it could break out? One of the things we've been looking at is it's been hovering around 2000 for a number of years. And I had Adam Barata from Brentwood Research on a couple of weeks ago, and he was saying that he thought that if it breaks through 2000 in the dollar price, that it'll scoot right up to 3000. Do you have an opinion on alternative currencies showing strength, or is that just dollar weakness?
Definitely. I don't disagree with any of those numbers. I think that's probably about right. It's got to hold above 2000, by the way. It's not just going to like cross 2000 and automatically go to 3. It's not quite that simple. But yes, generally speaking, against those former highs from 2011, I like it. In the same way that you look at Bitcoin and Ethereum, for example, and look at the prior cycle's highs at the end of 2017, when you're, remember the holidays of 2017, like your drunk uncle asking you how to buy Bitcoin, and like my high school buddies, JC, which cryptocurrency should I invest in? Not whether or not they should invest in cryptocurrencies, specifically which ones. My grandmother, Juan Carlito, she's from Cuba. She's asking, what's this new currency all about? It's like, it ain't new, and I'm selling all mine if you're asking me about it. You know what I'm saying? Like, exactly. That was the end of 2017. And what do we know after that? Cryptocurrencies collapsed after that. So anyway, that was the former cycle's peak. So if we are above that former cycle's peak, we could be long Ethereum, long Bitcoin. In a similar way to financials, if you look at the XLF, the S&P Financial Index, this summer when the stock market bottomed, financials were retesting the peak before the great financial crisis, literally to the penny. The highs in 2007 in financials, the S&P Financials Index, that high in 07, we retested that in 2018, failed. We retested that in 2020, failed. We broke out at the end of 2021, made new all-time highs in financials, and then last summer came back, retested those former highs successfully, and we could move on. By the way, same thing in the home builders, right? Home builders peaked in 06, literally when they launched the index, which is hilarious in and of itself, but that's another story. Same thing. Failed at those highs in 18, failed at those highs in 20, successfully retested those levels this summer. So that thought process behind Bitcoin, Ethereum, home construction, financials, same thing with gold. The difference with gold is, unlike those others, gold hasn't broken out yet. I think ultimately it will. And part of why I believe so, for a variety of reasons, is because gold's already been making new all-time highs in all the other currencies. And it's not anything new. It's been happening for years. New all-time highs in gold, price in yen. Definitely, I mean, anything priced in yen, but gold included. Gold price in euro, British pound, South African rand, Indian rupee, Aussie, CAD, Kiwi, new all-time highs across the board. So it's like, if you ask me, so what do you think the gold's going to do price in US dollars? And I look at all the other ones, I'm like, well, I think eventually this one does what all the other ones are doing. I mean, why would I bet against that? And just to further that point, gold just doesn't trade like a commodity. Gold trades like a currency. Gold trades like a currency. The US dollar got destroyed in the fourth quarter. How did precious metals do? Pretty damn well, didn't they? And the dollar had a little bit of a bounce over the last few days. How have precious metals done? Pretty terrible, right? So, right, there's a direct correlation. So I think you want to think about what the denominator is here. If you don't think the dollar's going to go down, and you think gold's going to go up, then you should bet on gold price in whatever currency you think is going to go down. Right? As investors, I understand. I live in America. You live in America, or whatever you guys call Baltimore, right? I'm just kidding. I like Baltimore, so I grew up an Orioles fan, for the record. So I'm just.
Oh, geez. Okay.
Yeah. And I love crab, so you got me. So I'm just messing around. But the point is, I live in America, and a lot of people are like, "Well, JC, I live in the United States, so I buy gold in dollars." And it's like, well, that's a choice, right? You could buy gold in any currency you want. So. I would reiterate to investors, don't be closed-minded to your borders. You want to think globally, because you know, I know the US stock market has done so great for 10 years, but stocks traded before 2011, right? And the US was like one of the worst places to be for a long, long time. So you really want to think globally. Stocks are an asset class.
Yeah. Yeah. JC, how can people follow along with your analysis, but also you have ways that people can actually get your advice and act on it too.
Listen, go to allstarcharts.com, check it out, shoot me an email, follow me on Twitter at allstarcharts. You know, we're talking about all things that are moving, whether it's a short squeeze or precious metals or energy stocks, you know, some coal names. I feel like nobody ever wants to talk about coal. We certainly do. You know, growth stocks. I mean, whatever's moving, cryptocurrencies, industrials have been hot. Insurance stocks are making new all-time highs. We've been getting rotation into emerging markets and other countries around the world. European stocks are doing great. And some people are like, oh, I only buy American stocks. It's like, well, you know, you should probably rethink that. And a lot of global stocks, especially the best ones, have ADRs that trade on US exchanges. So you can buy, not that I'm saying to buy these stocks, but for example, you could buy Alibaba, you know, or you could buy Petrobras, you know, or you could buy, you know, some of these, you know, healthcare names from Denmark that are killing it. Novo Nordisk, absolutely crushing it. AstraZeneca, you know, there are names around the world that trade on US exchanges. You don't have to just buy US stocks. You could just buy stocks that are going up.
Buy low, sell high.
See, that I'm going to push back on, because markets don't work that way.
Yeah, they don't. I know.
Right?
That's what the old timers say, though.
Right? Buy high, sell higher. No?
Yeah. Well, no, that's the old adage from the 80s of the buy and hold crowd.
You want to buy high, sell higher. Markets trend. So if you're buying low, it's probably going lower.
We just launched on the back end of the Wiggin Sessions here. We just launched a thing called the Essential Investor. And I am going to be hitting up you for advice on trends on a regular basis. And I'll be publishing it inside Essential Investor Forum, because price matters and the direction matters as well. So
the only thing that pays us.
Yeah, that's right.
There's no other way to get paid around here. We got to sell things higher than where we buy them. That's it. Right. It's a bottom line business.
All right, JC. It's good to talk to you today, and we'll talk again soon.
Thanks, Addison. Appreciate it.
I hope you enjoyed our discussion with market technician JC Parets. You can find his analysis and recommendations by going to allstarcharts.com. That's allstarcharts.com. If you did enjoy today's episode of the Wiggin Sessions, please let your friends and family know. Send them to jointhesessions.com. That is jointhesessions.com.